Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Zach Unger, Portfolio Manager. So happy to have you along here as we kick off January with a lot of big news. We'll try to unpack what it is, what it may mean to you. The big two topics today, of course, we're going to talk about Venezuela, in particular, the oil impact, and then Zach will break down sector relative performance. Something that we really want to pay attention to as we go from one year into the next. Which types of sectors do we see leading the way? So let's dive right in. We'll start with Venezuela, which has the potential to just be a massive story with many different ways it could develop, most of which is outside the purview of what we would cover here in the market carver. Just suffice it to say, it is a big story now, but has the potential to really totally reshape the trading relations and overall geopolitical relations within an entire hemisphere. So stay tuned. We don't know exactly which many directions this will take, but we do want to start with what the immediate impact is. And of course, that is oil. So Venezuela, as we know, is the largest oil reserves in the entire world, yet has not been a major producer, thanks to the mismanagement going back many different decades now. So off the immediate, we would not expect a huge impact. It takes a long time to go from reserves to output. So first you've got to have the infrastructure replaced, and something that appears to be going underway fairly rapidly. We'll see. So this could change in the future. It probably is much more about a 2030 or maybe even 2035 story than it is today. And you can see that out on this chart here, just comparing Iran and Venezuela, which, by the way, Venezuela is a founding member of OPEC. We often think, or at least myself, think of OPEC as being the Middle Eastern countries, but Venezuela, one of those members, but producing about 1 million barrels per day. That puts them at about 1% of the world's 100 million barrels per day. So that isn't going to change quickly, but given their amount of reserves, could very well change 5 years going forward. What's interesting about this timing here is that oil has pretty much been in a structural bear market as we have a glut of production. So anything that does come will be adding to that. However, that is a market known at this point. It's been downtrending in price, basically trading as if we were in a combination of a recession and a glut. So for a contrarian stake, and we talked about this in our preview to the year, that is one potential to surprise some people. And in fact, ever since the news over the weekend, oil has actually edged up in price, which is exactly the opposite of what one would have thought. The other implications here is 1 barrel of oil does not equal the other. Of course, there's different degrees of sulfur content, and what you really wind up with is a light, medium, and heavy. You can see that on the next chart here. And so in the US, where we've really wound up with a lot of production going back 10, 15 years now, most of that oil that we produce is of the light nature, and something that our refineries, which take decades to put into place, wasn't equipped to really refine a whole lot of. So we wound up exporting a lot of our oil production and import oil to then refine. So Venezuela's reserves are very much of that heavy, and we are very much set up in the United States to refine that. So we would expect that to be, something to watch going forward. There's a nice clean match amongst those oil types. So that is enough about oil for now. We will stay tuned to the entire story, of course, as this will be a very long-term developing story. But Zach, let's take it to the more here and the now and look at sectors and relative strength.
Yeah, we'll talk a little bit about the equity markets as we move into 2026. The chart on your screen is a little bit small, but we'll do our best to break it down and make it clear for you. One of the ways that we can look at market participation, where the strength is by taking the market and looking at it in sectors. Which sectors are performing, either underperforming or outperforming relative to the broader market, the S&P 500. And so that's what the chart on your screen is here. Each of the sectors and their performance relative to the broader S&P 500. We're coming off of 3 very, very strong years for the S&P 500, but one of the primary headlines or the primary topic of conversation has been how much that performance has been driven primarily by just a handful of names, the Mag 7, sometimes even fewer than those, almost all of which are concentrated in the tech sector, or are adjacent to the tech sector. And so you can see that top left portion of your screen on the chart there, technology with strong outperformance, certainly through 2025. But if you expand that chart out and go back a couple of years, it's been pretty strong performer and has driven a lot of the market gains. What we're seeing though, really through Q4 of last year and then into the beginning of this year already, are some other sectors start to participate. You see industrials on the bottom and communications starting to pick back up. Materials and financials are starting to move in the right direction. Healthcare has been a big winner through much of 2025 and is continuing to do so far in 2026. In fact, through the first handful of days here, it's a small sample size, but tech in terms of the sector performance is actually in the middle of the pack. You have materials and industrials and financials and healthcare all outperforming tech so far. So what that means, to just simplify, is that there are more opportunities, or at least appear to be more opportunities in the market outside of the Mag 7 names or just the broad tech sector that has driven much of the market for many of the past years. So it's good to see more participants in an up market. We talk about that in terms of breadth. We want to see a lot of participation. And certainly when you look at the sector performance relative to the S&P, it looks like we are starting to get a broadening out of participation, which is typically healthy for an up market.
Very good. Thank you, Zach. And thank you to all of you for giving us this time. We sure do appreciate it. If we can be of service, please don't hesitate to reach out, either giving us a call, 800-928-4001, or scan the QR code and do so electronically. Thanks again and have a great weekend.